We had a pivot last week from the Fed, but the UK numbers today telling us perhaps the Bank of England may not be too far behind. A 3.9% handle on UK inflation. Now, what's your reaction?
As you say, the Bank of England may not be too far behind, but I think it will be behind the others. I mean, this is a good release. This is the release for November. It did come in a bit lower than expected. But on headline, we know that a lot of that is the energy story. This time a year ago, energy was adding about 4.5, 5 percentage points to overall inflation. Now it's detracting about 1 percentage point. So actually, for me, the good news was in core CPI. That came in lower than expected. That's where UK inflation has been so much more kind of rigid, stickier than, for instance, in Europe or indeed the United States. So core inflation coming in at 5.1, much better. A few kind of exceptional moves in there. It seems to be more driven by recreation and culture. Computer games apparently played a role, so I wouldn't get overly excited, but it is good news. But they'll need to see further progress because they're not going to get much help from energy even before the recent developments this week through the course of 2024. They need to see that core inflation move steadily lower.
Janet, you're sounding like a central banker there. Don't get too carried away with rate cuts at this point. But when it comes to a pivot and timing markets, it's all important, isn't it? Who else is going to pivot, when they're going to pivot, and what sort of rate cuts we're going to get. So what's the timing then for the Bank of England, and what scenario do you see on the rate cutting side for 2024?
Well, I think the markets have got, maybe a little bit ahead of the game. We have got rate cuts from all the major central banks, but we think the Fed and the ECB will lead the way. We've got those rate cutting rates for the first time in June. For the Bank of England, we think that the first rate cut happens in August. So headline, we are looking for headline inflation to fall materially further towards the middle of next year. But we are seeing some signs of a softening labour market. UK wage growth is a lot higher than elsewhere. We will need to see wage growth trend a little bit lower. And actually, we're not overly negative on the UK economy. Some are obviously warning of a very hard landing. We don't have that. This fall in inflation is really better news for consumers. In wage growth is currently higher than inflation. So that real intense squeeze on real wages is lessening. So that offsets some of the slowdown in the labour market. So August for the first rate cut, and less from the Bank of England next year than from the Fed or the ECB.
Yeah, Janet, in relation to that, good morning to you. I mean, does that bode well for UK growth then as well? Because if rather the inflation story has declined a little bit more than wage growth has, it is still a little bit higher than inflation is wage growth. Does that mean that the growth picture for this year, because a little bit more spending, rather next year, should I say, looks a little bit better?
Well, yeah, possibly. I still think that everywhere is going to see a further slowdown in the coming months. But, one of the key points that I keep making is this is a very unusual cycle. Usually when you see a sharp reduction in inflation like we have seen over the course of the last 6 to 12 months, it is a consequence of a recession or a big jump in unemployment. But because so much of this, growth hasn't been good, but there hasn't been a recession. But because this time inflation has come down beforehand, consumers, the price level is still high, as you rightly pointed out in your introduction. The cost of living squeeze is still there. The price level is still high, but inflation is slowing more rapidly than wage growth. And so, yes, relative to some of the expectations, I think that UK growth may prove to be a little bit more, show more stabilisation and modest signs of improvement through the course of 2024.